Hello and welcome to our latest Off the Road webinar on pension benefits, accessing pensions and taking lump sums. My name is Lisa Webster. I'm Senior Technical Consultant here at AJ Bell. If you want to ask questions as you're going through the webinar, there should be a box on the right of your screen for you to be able to do that. Put some questions in there. I won't be taking questions as we're actually going through, but if you do fill that in, we will get those, and myself and one of my colleagues will come back to you. So please feel free to use that function. Okay, so today I'm going to talk about when benefits can be taken, first of all, how we can first access pension benefits. I'm going to look at the lump sum options available, and I'm going to look at the taxation of flexible payments and some of the issues that arise around that. I will be doing another webinar later on in the series where I look at pension benefits and the drawdown options. It's just a bit much to cover all in one session. It'll be quite a lengthy session, so that one will be coming if that's what you're interested in. But today we say this is what we're going to be focusing on. So to start off with then, when can benefits be taken? When can we first access pension benefits? Well, as I'm sure you're all aware, we have a normal minimum retirement age for accessing pension benefits of age 55 at the moment. Now, there are plans for this to change. It was part of the pension freedom consultation, part of the consultation document when they brought in the new freedoms in 2015. They've also said that they are going to raise personal pension age. And they're going to do that, raising it to age 57 by 2028. And then the plan is that it's going to be linked to state pension age. So state pension age at the moment, we've gone through the process of equalising men and women, bringing it up to age 65. And we're now going through a process of a gradual increase for state pension age from 65 to get it to 67 by 2028. It is already over age 65. I think to retire today you have to be about 65 and 9 months or something like that. So we're going through these gradual increases. Once the state pension gets to 67, we're not going to have a gradual increase when it comes to personal pensions. It looks as though we're going to have a cliff edge. We're suddenly going to jump from 55 to 57 in 2028, but then from then on, then it should be tied with this 10-year link as state pension further increases, which at the moment is planned to 68 that we know about, though obviously things can change. Then it will be a gradual increase linked to maintain that 10-year gap. Now, this has been talked about obviously for a while. The government confirmed that they were planning to do this in the Pension Freedoms Consultation response back in 2014. At that point in time, they also said that the government will legislate for these changes in the next Parliament, but that hasn't actually happened. So at the moment, this is all planned, but there isn't actually anything written in legislation to confirm that it will happen. That said, it was talked about in the build-up to the budget earlier this year, because there were some reports out there, suggestions that they're actually going to bring it forward, and we were going to have an increase in terms of normal minimum retirement age a little bit earlier than 2028. That hasn't happened now, and I don't think that's imminently on the cards. But yeah, I think it is coming. So depending on the age of your client, when they're going to be affected by that, but clearly that's one to bear in mind. Outside of normal minimum retirement age, there's a couple of other circumstances where people can access their pension benefits legitimately at an earlier age, when the ill health condition is met, or if they have an earlier protected pension age. So I'll have a look at a bit more detail at those. So first of all, we have the ill health condition. So there are 3 requirements in terms of HMRC rules when somebody can access their pension benefits before age 55. This is if somebody is incapable of performing their current occupation, and they're going to continue to be incapable of performing that occupation, and they've actually ceased to perform it. So they've actually stopped working. When these 3 conditions are met, then HMRC rules allow the individual to access their pension early, and they access it in the normal way. So if somebody qualified for ill health benefits, they would still have the same options available as you would have normally. So under a personal pension, PCLS, tax-free cash, which we like to call it, taking drawdown UFPLS payments, but they combine annuity. If in an occupational scheme, they could have a scheme pension available, and those benefits will be taxed in the usual way. So you'd have your 25% tax-free normally, and then the rest of it would be subject to income tax. But not all schemes will allow a sort of as generous interpretation of the rules as HMRC do. So taking the first point there, incapable of performing your current occupation, some schemes will have more stringent rules. Generally speaking, it'll be an occupational scheme, and they might say instead of being incapable of performing whatever your current occupation is, you have to be incapable of performing any occupation in order to qualify. So, for example, you could have somebody who had a physical job, who suffers an injury or an illness, which means they're not capable of doing a physical job, but they're still capable of doing a desk job. In those circumstances, some schemes might say, well, no, you're still capable of working, therefore we won't pay out ill health benefits. If that's written in their scheme rules, then they're perfectly entitled to do that. Other schemes will be more generous, and certainly say the HMRC rules allow that it can be just if you're incapable of performing the current occupation. So in that scenario, if you had somebody who had a physical job and they were incapable of carrying it out, so they stopped work, they met all these conditions, they're never going to recover from this, they're never going to be able to go back to performing that job, and they stopped doing it. If they cease work, they can access benefits. If they then go and get that desk job at a later date, so they do start working again, that doesn't invalidate the fact they're already taking benefits or make it an unauthorised payment as long as they met the condition at that time. What you do have to be careful with is things like transfers, so you don't have somebody who stops working because of the illness, then decides they want to transfer the pension for whatever reason to another scheme. They join that new scheme, they then start another job, and then they try and access it. So they start the desk job and then they go and, they start the desk job before they transfer, and then they try and claim under the ill health. The point is when they join the new scheme, their current occupation will be that new job, so they wouldn't meet the criteria. So you just have to be a little bit careful with transfers on this. In terms of the evidence that the scheme administrator is going to require, they need confirmation of the first two bullet points from a recognised medical practitioner. What we find in practice is that getting confirmation that the individual is incapable of performing their current occupation is quite straightforward. Normally you get that confirmation from the consultant, from the GP, doctor, whoever it is, and they'll confirm that they can't carry out the current job. What we find a little bit harder, or we get a lot of letters that don't meet the criteria, is for the second bullet point, is getting this confirmation that in their medical opinion they're not likely to be able to recover from this to the point that they can return to work. What we have done is we have a standard form, so if you do have any clients that you think may meet the ill health conditions and they're wanting to access their pension benefits, and it's for the pensions with us, then I would say just contact us. We've got a form which kind of covers these points, which they can take to their doctor, get their doctor to complete it, to confirm those points and send it in to us, and it just saves a lot of sort of going back and forth, which can be quite difficult at times to get the evidence on this. For the third point, we can just accept confirmation from the member themselves that they have to sign a statement to say that they've ceased to perform that current occupation. Moving on then, looking now at protected retirement age. So some people will have an entitlement to access their pension benefits earlier, where they had that right before we had pension simplification back at A-Day. There's two sort of methods of people having this protected retirement age. The first one is if they have an unqualified right under the scheme rules at the 5th of April 2006. So what that means by an unqualified right is just that, you know, everybody who's in the scheme at that point of time automatically had the right to a younger retirement age, which was usually age 50 for most of these. These were the age 50 ones. So they had that right. They didn't have to apply for special permission. It wasn't a special dispensation or based on certain circumstances. It was just a standard right that members of that scheme had. And it had to be in the scheme rules on the 10th of December 2003. So that had to be in the rules when pension simplification was announced, say December 2003. And then as long as the person was a member of that scheme by 5th of April 2006. So they had that right, because the scheme rules, even if they joined the scheme in between those dates, they joined a scheme which had those rules in place and they had that right on the 5th of April 2006, then they can retain that right to that protected retirement age going forward. Now, it had to be, you say, in the rules of the retirement benefit scheme or a deferred annuity contract. So there's quite a few Section 32 policies which will have this right to a protected retirement age as well. Some of the schemes that had these rights, you have to be a little bit careful. There's a re-employment condition as well, so that if the individual retired using the protected retirement age, so in practice that's going to be somebody retiring normally between 50 and 55, that if they retired but then carried on working for that employer or a connected employer, then they might lose that right under the scheme. And that also continues even if they've transferred out of the pension scheme, but they still can't go back to that original employer who was the sponsoring employer of the scheme where the rights originated. So you do need to be a little bit careful with that one. And the other people that have a right to a protected retirement age were those who were in a prescribed occupation on the 5th of April 2006. So this is your sports stars, really. There's a few interesting occupations on there, but it would certainly include this lot, our World Cup squad from 2006. They were members of pension scheme, personal pension schemes at that point in time, and they were on the list. Professional footballers is one of those prescribed occupations. So lots of cricketers, rugby players, dancers. I think my personal favourite on that list is trapeze artists. I don't think I've ever actually come across a trapeze artist in one of our schemes that's got a protected retirement age, but you know, there'll be some out there somewhere, I'm sure. So yes, they just had to be a member of a scheme and have that right and be in that occupation on that date in immediately prior to A Day. Of course, with these people, however they've got the right, whichever method it is, then you do have to be careful with transfers because they retain the right whilst they stay in that original scheme, but they will lose the right to the protected retirement age on transfer unless it meets the block transfer rules, which a simplified version of them is, you know, you have to transfer with at least one other member from the same scheme, same seeding scheme to the same receiving scheme. It has to be a full transfer and you can't have been a member of the receiving scheme for more than 12 months at the point of the transfer, and you have to transfer all your benefits across. So you have to do the block transfer rules or else you lose that entitlement. And in terms of the retirement age, I say the ones under scheme rules were normally age 50, but under the prescribed occupations, they did vary a bit. And footballers was age 35, some of them were 40. There was some variance in those, but on those, depending on what the actual occupation was. When it comes to people with a protected retirement age taking their benefits, they do have a few more restrictions imposed on them if they're making use of that retirement age, that early retirement age. They have to take all benefits on the same day. So you can't do any partial crystallizations, it's all or nothing. So that will include obviously the benefits that are built up to A Day, but also any benefits built up after that. So any, obviously they carried on contributing to the scheme. If they've had transfers in from other schemes, all of it, whatever's in the scheme that has got the protected retirement age at the date they want to use it, they have to take all benefits, full crystallization. They can, after they're fully crystallised, make further contributions. Obviously, if they're taking income, you might be careful with the MPAA, it might restrict you, but if somebody's just taking PCLS, for example, they can still have unlimited contributions. They can build that up, that's fine in the same scheme, but those would have to wait till normal retirement age in order to be able to access them. Just a quicker point on lifetime allowance. I'm not going to talk a lot about lifetime allowance today. Obviously, it is very connected with pension benefits. But my colleague Rachel recently did a webinar on lifetime allowance, where she's talked about the different benefit crystallisation events and how the lifetime allowance calculations are done, etc. So, if you want to know more about that, please go and have a look at that webinar. If you missed it first time round, it will be available on the website for you to access anytime you like. All I'm going to say in relation to protected retirement age is, if your protected age is 50, there's no reduction in the lifetime allowance. You treat it exactly the same as anybody else. If somebody is under the age of 55, then you lose 2.5% of your lifetime allowance for every complete year from the date you take your benefits, the benefit crystallisation event, to age 55. So there is an impact, obviously, on the LTA usage of taking benefits early. So that's sort of age and how you can access benefits. Now I'm going to look at the lump sum options and what you can do in terms of lump sums under personal pensions, and some of those will be under DB schemes as well. So pension commencement lump sum, PCLS, the most well-known way of taking lump sum from pensions. Uncrystallised funds pension lump sum, that horrible tongue twister, awful phraseology that we have, UFPLS, UF+, whatever you want to call it. We have small pension payments, I'll look at the rules on those. Serious ill health lump sum, I'll look at those conditions. At the bottom there, I've got trivial commutation lump sums and winding up lump sums. Now, those last two, they are only available from occupational schemes. First four can come out of personal pensions. I'll talk a little bit more about the trivial commutation one in a moment or two. Winding up lump sum, I've put it on there for completeness because this is the list of the lump sums you can have in members' lifetimes and the benefits. You're not going to come up against too many winding up lump sums. They are only from occupational schemes. It has to be less than £18,000, the lump sum. There's no LTA test, but they do have to have some lifetime allowance available. The employer, whose scheme it is, the sponsoring employer of the scheme, can't be paying into another scheme for the member. And it has to extinguish all rights for a winding up lump sum. They can be taken at any age, so it's not retirement over 55 when they are any age. So let's look at the rest of them in turn then. Starting off with the PCLS, pension commencement lump sum, tax-free cash, as it used to be called in old money. And obviously we get our annual, when it comes around to budget time, the fact that we removed the words tax-free from it, thinking that people are just going to get taken away from us at the budget, and it's never happened yet. So let's hope that stays the case. So pension commencement lump sum then, usually 25% of the fund value up to the available lifetime allowance, and it's paid out completely tax-free. Obviously, it's usually 25% of the fund because there are slight variants, slight exceptions as ever with most rules in pensions. So for most people, so with 25%, if somebody has fixed protection, any of the fixed protections, the relevant fixed level, you substitute that for the standard lifetime allowance. So if you've got fixed protection at 1.8 million, then you have 25% of that, 1.5 million, 1.25, that's fine. People who have enhanced or primary protection, but don't have lump sum protection connected with it, for them, in practice, it's going to be 25% of 1.5 million. The rules state it's the greater of 1.5 million and the standard lifetime allowance. It's going to be a few years, I think, before the standard lifetime allowance is over 1.5 million. So for now, it's the 1.5. Of course, those that do have protected lump sums, scheme-specific protected lump sums, will have higher amounts, and those that have lump sum protection in connection with our enhanced or primary protection will also have a higher amount. But for most people, it will be a straight 25%. As So as the clue is in the name, really, it's a pension commencement lump sum. You have to commence your pension in order to take the lump sum. You can't just take a PCLS by itself. You do have to do something with the rest of the fund. I think for a lot of clients, members, they probably think that yes, you're just taking the tax-free cash and that's it. But we know that's not the case. You can't just do that. So in SIP world, most people who just want to take their PCLS, they're going to put the rest of the fund into drawdown, even if they don't want to take any income from it straight away. That's what they'll do with it. Of course, they can buy an annuity with it. In DB land, you have a scheme pension and you take the PCLS in association with your scheme pension. Of course, the fact that you do have to do something else with it is, I suppose this is a big focus of the retirement outcome review that the FCA have done recently, and their plan to introduce investment pathways so that people have to do something, have to make active decisions with the rest of the fund when they take a PCLS, that they, it doesn't just default into cash for the rest of it. So those are the pathways which were due to come in August, have now been postponed until February. And we may do another presentation on a bit more detail on that one at a later date. PCLS has to be paid within 12 months of you commencing pension benefits. Now, in practical terms, personal pensions, I think everybody just pays it straight away, which is certainly what we do. Maybe slightly different in DB world, where you start your scheme pension, you might take it out a little bit later on, but as long it might take it out shortly after you've started your scheme pension. Member can choose not to receive a PCLS. You don't have to have it. Again, in DB land, there may be circumstances where it's appropriate not to take a PCLS, mainly because if somebody doesn't actually need the lump sum, and depending on the commutation factor of whether you think it offers value for money or not. When it comes to personal pensions, DC, I can't really think of a good reason why anybody wouldn't take a PCLS. So in theory, they can refuse to take it, choose not to take it, but you're just choosing to have some of your income tax that doesn't need to be. So I can't really think of any good reason why you wouldn't, even if you didn't need a lump sum, then you use it to take, regular UFPLS payments or, phased drawdown, using a little bit of it as tax-free income. It can be paid after age 75. We do get asked about this, on a reasonably often basis. Yeah, there's no rule that says you have to take it by age 75. So if you haven't fully crystallised by age 75, you do have a lifetime allowance test at age 75. Even if you're fully in drawdown, you still do. So you have your age 75 test. When it comes to taking PCLS after age 75, technically there's no further LTA test, because you can't have a test after age 75 apart from in relation to scheme pension. But there is still a test of sorts in that you ignore what happened at age 75, the age 75 LTA test, but you look back at what's happened previously to calculate the amount of lifetime allowance available, therefore how much PCLS you can have. But you can never have an LTA charge in relation to it. So it's not a test as such, but there is a calculation that we have to do to get it after age 75. But it is perfectly possible, and we do have plenty of cases where we do pay PCLS to people after age 75. Moving on to UFPLS, lovely named. So UFPLS was a new concept that came in with pension freedoms in 2015. When we first saw this, there was a bit of a question about, why have they done it? Because in practical terms, there's not a lot of difference between taking a PCLS payment and the maximum income under flexi access drawdown. Doesn't really make a lot of odds. But I think they've done it because there's some schemes that won't offer drawdown who can offer a UFPLS. So I think that's why we've got it. You have to have available lifetime allowance in order to be able to make a UFPLS payment. So you have to have a little bit of it, but in theory you can pay above it. But if the amount of the UFPLS that is above the available lifetime allowance would actually be subject to the lifetime allowance excess lump sum, so chargeable at 55%, assuming it's taken before age 75. But UFPLS in general, up to the lifetime allowance is 25% tax-free and 75% taxed. One difference between taking a UFPLS and, say, taking a PCLS payment and maximum income under Flexi Access drawdown is the fact that it's only one benefit crystallisation event, it's one BCE, whereas if you take PCLS drawdown, it's two. In most circumstances, that's not going to make a difference. There is, with the way the rounding works on the LTA, it can make a tiny difference in terms of your lifetime allowance available. Because to say the rounding works actually means you might use them slightly more, like 0.01% more under a UFPLS payment than you would do under PCLS and drawdown. So it's not going to be appropriate for me, relevant for most people. It does trigger the money purchase annual allowance because it is the pension freedom flexible benefits payment. So anybody who takes a UFPLS payment will have, they can only pay to £4,000 under the money purchase annual allowance to money purchase pension schemes going forward once they've done it. You can't have a UFPLS payment if the member has either primary or enhanced protection with protected lump sum protection, because that protected lump sum amount it'll be more than 25%, so you would want to use a UFPLS payment. You can do it if someone's got primary or enhanced but they haven't got lump sum protection. That can happen. And like with the PCLS, it can be paid after age 75, and again you just ignore the age 75 test when you're calculating the amount available. Just one little sort of slightly random niche point, I should say, is if you do have somebody who has disqualifying pension credits. So these will be where somebody has received a pension credit as part of a pension sharing order on divorce. It's disqualifying pension credit, then you can't have a UFPLS payment. Effectively, it means the ex-spouse has already had the tax-free cash. The member with disqualifying credit can't have it as well, so you can't have it on that. One of the issues that we have with UFPLS payments, particularly one-off payments, and it is an issue to a certain degree as well, if one-off payments under Flexi Access drawdown, is how they are taxed. The taxation of flexible pension benefits is a major problem because HMRC overtax. Now, this is an issue that has been going on since pension freedoms came in 5 years ago. And it's not going away. So you see, I've got some headlines here. This one is back from 2017. There was a lot of press around, been going on, rumbling on for a couple of years. I think people didn't really realise how big an issue it was to start with. And then, it was a bit more of a story a couple of years ago, obviously in the trade press there, and also, made it into the consumer press about people being overtaxed because of pension freedom payments and how HMRC taxed them. This is certainly something we've, raised with HMRC on a number of occasions, not just us, it's been other people have. There was rumours before the budget it might be being looked at, but nothing has happened. It's a known issue. HMRC know about this problem, but nothing seems to be changing on it, as we can see, because these are headlines from this month, that now, since pension freedoms came in, HMRC have overtaxed people to the extent that they've had to, the £600 million has been reclaimed from pension freedoms because of this problem. And that people, this question here, are people due a refund because they overcharge people tax, and then you have to try and you have to get it back from HMRC rather than them getting it right in the first place. So I just want to have a quick look at this in terms of what the issue is, and why is it an issue, and why is it different with pension freedom payments that it wasn't an issue previously. So it all comes from sort of how HMRC tells scheme administrators they have to apply tax codes. So it's nothing to do with the discretion of your scheme administrator. We wish we had that power, but we don't, to change this. So in terms of tax codes that we have to apply to payments, if we have currently a tax code for an individual, we can apply that code, that's fine. Now, in practical terms, when somebody starts taking benefits, the first time, we're not going to have currently a tax code. We're only going to get that if they've already started taking the benefits And after that first payment, then we can get sent the current year tax code. So the issue is when people are taking one-offs, regular income is not an issue really. So we don't have a current year tax code for somebody. They might have a current year P45. It might be somebody has just, finished work and then they're now accessing their pension to replace their work income. If they've got a current year P45, great, they can send that to us. We are allowed to apply that code, but we have to do it on a month-one basis. If we don't have a current year 45, then we have to use an emergency code still on a month-one basis, and that code for this tax year is the 1250L code. So whether we have a current P45 or not isn't really the big issue on here. It's the fact that we have to apply on a month-one basis. Even if we know the individual is only going to take one-off annual payment. We're not allowed to put it on a month 12 basis, which under cap drawdown, where somebody tells us we're allowed to, that they're only going to take an annual payment, HMRC will allow us to do that. We can apply a month 12 code so they can get taxed correctly. But there's kind of like dispensation they've allowed us to do that. They haven't carried that across to pension freedoms. So we're not allowed to do it for UFPLS payments. And similarly for somebody who's taking flexi access drawdown, if they're taking a one-off payment under that, we're not allowed to do it. And that can have a really big impact. So it's this month 1 against month 12 issue. So we're being told we have to apply a month 1 tax code, which means it's based on taxes based on that pay period only and tax allowances for that pay period only. So each month is treated discretely, and you only get a 12 for the personal allowance, a 12 for the basic rate band, higher rate band, and then anything above that is taxed at additional rate tax. Obviously, these tax rates I'm referring to, and in my next couple of slides, are for England. They were correct for England, Wales and Northern Ireland. For those of you north of the border, apologies, the same principle applies, but obviously your figures are going to look slightly different with your different tax bands. For month 12, which is say we can do with cap drawdown, but we can't do it with UFPLS payments, the tax is based on the whole year. So you get full tax allowances for the whole year, full personal allowance, basic rate tax band, high rate band. So it does make quite a big difference. And it doesn't matter when in the month, when in the tax year this payment is. So a month 1 issue, that might make sense if somebody was taking a payment in April, because you might think they're going to make subsequent payments in the year. But even if under these rules, even if we're making a payment in March and they've never taken any income from the pension fund, it's the first time they've ever accessed that pension, we still have to do it on a month 1 basis, even though we're at the end of the tax year. So it doesn't make any difference. So I'm going to have a look. We've just got an example of what an impact that can have. So this is ad hoc payments. The issue is when people are taking one-off payments. So say if people are taking regular payments, they may get overtaxed on the first one, but then we'll get an updated tax code. And with regular payments, it should get corrected throughout the tax year. Problem is somebody taking a one-off payment, and even though they tell us that, we know, even if it's at the end of the year, it's on the 5th of April, they're not taking any, we know it's going to be a one-off payment, it doesn't make any difference. We still have to apply on this month 1 basis. So in this example, I've got somebody who's taken a one-off UFPS payment of £100,000. I've used quite a large figure, so it makes the gap bigger, demonstrates, what a dramatic difference it can have. But there's a big impact, whatever figures you're looking at, even at lower level of figures, there will be an overtaxation. So effectively, under a month 1, it is basically saying you think you're going to get that every month. So £75,000 taxable income every month, you're going to be taking 900,000, which obviously is a huge difference. So if we look at the chart now, so at the top of it, if you've got £100,000 UFPLS payment, 25,000 of that, 25%, £25,000 is tax-free. Don't have to worry about that. So 75,000 will be subject to income tax. On a month 1 basis, you get a 12 for the personal allowance, so £1,042, versus on month 12, you get the full £12,500. Some of you might be thinking, if this thinks that you're going to have £900,000 income in the year, you're not going to have a personal allowance. And of course, you'd be right. However, the way that PAYE works is that with the first month, it'll always give you on a month-on basis, is always going to give you a 12th of the allowance. Your tax code that you get through later, if you're going to take further payments in the year, it would effectively, in those later payments, it would claw it back off you, the personal allowance. So it isn't a mistake, it is deliberate that the personal allowance is still in there on the month one column. So you then have your amount chargeable to basic rate tax. So month 12, you get the full 37,500. Month 1, you get 12th of that. And then you get tax at basic rate, 20% on the amount chargeable to basic rate tax. We then go down to higher rate tax. So on the month 1, you get a 12th of the higher rate band, £112,500. So 12th of that is 9,375, which is taxed at 40%, your higher rate, to give you the 3,750 figure. On the month 12 side of things, it's just the balance of your payment. You've only got £25,000 left after your personal allowance and your basic rate tax. So 25,000 of that is charged at higher rate tax, 40%, to give you that 10,000. Back on the month 1 side, you've got the balance of your income payment, which all falls into the additional rate tax band, and that's taxed at 45%. So you can see under month 1, you get taxed at just over £32,000, whereas on a month 12 basis, you'd be taxed at £17,500. So you've got nearly a £15,000 over taxation on that one payment. So this is the issue. Now, you can claim it back. Well, you have a couple of options. You can wait until the end of the tax year, and HMRC should correct it via the P800 tax calculation. Now, so it's going to depend how much you need the money and when in the tax year it is, whether you're willing to wait for that. You know, if you're taking a payment in April, you're not going to want to wait 12 months. If it's March, you know, maybe you would, depending on the circumstances. If not, you can make an in-year reclaim of it, which we'll come and look at. So in-year claims then. There's various forms depending on the circumstances. So if the pension fund has been completely empty, then you'll need to send, the client will need to send a P45 with a form P50Z if they don't have any other income, or it's a P53Z if they do have other employments or income. If they haven't emptied the pension fund, they're just taking a one-off payment from it and they're not going to take any more withdrawals in the tax year, then you can use the form P55 and send that across to HMRC. And you know, you generally get them back, you know, it's a few weeks, but it's these 3 forms together which added up gave the £600 million figure that was on the headlines from earlier this month, because using by these 3 forms for in-year reclaims, that's how since pension freedom started is now total £600 million that HMRC has had to repay to people from overtaxation. So that £600 million figure doesn't even include people who wait for the P800. So the overtaxation issue is actually larger than that. So it's quite significant. Obviously, when you're planning, if somebody's wanting to take a one-off payment, UFPLS payment, and they need amount of income and whatever the figure that they need to get out of it, you need to take into account, you know, and manage their expectations that they are going to get overtaxed on it the first time they take that payment. And so they might be getting less than they think they're going to, and then they can do a tax reclaim, but it's going to take a few weeks before they get the rest of the money. Okay, moving on. Next one I've got on here is serious ill health. So this is another kind of lump sum that you can take from your pension. Now, hopefully you don't get very many of these, but obviously, you know, there's always a chance this could happen to anybody in your clients, that you may come across clients in this unfortunate position. So to qualify for a serious ill health lump sum, they have to have a life expectancy of less than a year. So we're looking at people who are terminally ill. You can only take an ill health lump sum from uncrystallised funds. They have to have some lifetime allowance available to qualify, and they have to take all of their benefits from that arrangement. So it has to extinguish the member's entitlement to receive benefits from that uncrystallised fund. They can be paid out at any age. serious ill health. You don't have to wait till age 55. If somebody is unfortunately terminally ill before that age, then they can access it. It is completely tax-free. So this is the advantage of taking a serious ill health rather than ill health benefits, or if you're 55, just taking it under drawdown. So effectively, it's really like an advance on death benefits. You know, if you're under age 75, it's tax-free. So death benefits under age 75 are paid out tax-free as well. But it just means the member who unfortunately isn't going to get to use their pension in their lifetime, because they're not going to live long enough to need to use their pension, that they can have it tax-free in their lifetime. Now, for wealthy clients that don't need the income, then you're probably not going to be doing this if they've got other sources of income, because obviously it's a tax advantage environment and it's outside their estate, usually if it's in the pension wrapper. But you'll certainly, you know, there will be clients in circumstances where, you know, having this tax-free, you know, can make a big difference to them in their sort of last few months. You know, if they want to pay for, you know, private medical care treatment, if they've got a bucket list of things they want to do, if they don't have any dependents to worry about, you know, if they just want to spend it on themselves to make the most of what time they've got, you know, there are circumstances where this will be appropriate. It is a benefit crystallisation event. It is tested against the lifetime allowance. So you do have to crystallise all benefits that somebody is over the lifetime allowance. The excess is taxed at 55%, but it's still all taken at the same time. You can't do partial crystallisations. You do have to take all the benefits in one go. But of course, if you've got uncrystallised funds, you can do a partial transfer. So if you had somebody who, you know, met the criteria, maybe wanted some money now to spend in their lifetime, but were, you know, concerned about still wanting to keep the rest of it in the tax wrapper of the pension outside the estate, etc., is you could potentially do a partial transfer of however much they wanted to take, and then once you've got that in a separate arrangement, you could then take all of that, fully crystallise that as a serious ill health lump sum. So that might be appropriate in some circumstances. Slight tangent, but whilst I'm talking about ill health payments, just as a planning point to think about really is, so we're talking about serious ill health, people being terminally ill. You know, most people who end up in that position will have had an illness for some time before they get to the point of having less than 12 months to live. And so if you have somebody who is wanting to access pension benefits for the first time in ill health, be it they're accessing it early under the ill health rules, or they could just be over 55, but you know, they're accessing it because of ill health. So when you take benefits normally, they're taxed after your PCLS, whereas serious ill health lump sums are completely tax-free, say up to 75, up to their lifetime allowance. There is a sort of an argument that it might be in their interest to crystallise as little as possible whilst they're in ill health for an individual that, you know, they have a condition that they're not terminally ill, they've not got less than 12 months to live now, but it, you know, it's not unreasonable that they may get to that point, that if you crystallise as little as possible, so for their immediate needs, leaving as much fund uncrystallised, so that if they do reach the point of being serious ill health and they have less than 12 months to live, that they can then have access to the rest of their fund completely tax-free. Whereas if you'd already crystallised it, they wouldn't have that option. So it's probably a bit of a niche one, but you know, in certain circumstances, it could be right for them. Okay, last couple to go through now. Smaller pension payments. So smaller pension payments are available from defined contribution schemes still. These rules I've got on the slides now, these are the rules since 2014, the limits, and some of the rules were slightly different prior to that, so these are the current rules. So small pension payments are for payments up to £10,000. The idea being, if you have a very small pension fund, so the rules were put in place sort of thing, you know, if it wasn't worth buying an annuity with it or whatever, you know, you've got small funds, we could just pay those out. In most circumstances now, you don't need to use the small pension payment rules, because you can just take a UFPLS payment or PCLS and maximum drawdown and take it all out in one go anyway. So they're not that often used. The reason we get asked about them, well, the main reason we get asked about it is because of this last bullet point I've got on there. It's no lifetime allowance test. Small pension payment doesn't use up your lifetime allowance, whereas obviously if you do it under FAD or UFPLS payment, it does. It is at an arrangement level. You can have these payments up to £10,000. So you could have somebody, you know, who's got £1 million, you know, in one pot, one arrangement, one scheme, and then they've got, you know, £9,000 and another one somewhere else. They would still qualify. It doesn't matter the fact they've got a huge pension fund on, you know, on one side somewhere else, because it is just at an arrangement level. The way they're taxed is as for other benefits. So if they're uncrystallised, 25% tax free, 75% taxed. If it's from crystallised rights, then it'll be 100% subject to income tax. We do get asked about this, I say because of this no lifetime allowance test, we do get asked sometimes for clients with lifetime allowance issues if we would move £10,000, if we do a partial transfer, if it's uncrystallised, a partial transfer of £10,000 from the main scheme into a new arrangement in order to facilitate a payment out under small pension payments of £10,000. You know, whether we do that 3 times, because you can have up to 3 payments from all schemes. Personal pensions, there's no limit on occupational. Whether we would do that so they can get a little bit more out without having a lifetime allowance charge on it. Now, technically, the rules do allow that. HMRC rules do allow you to move it to a separate arrangement. It doesn't even have to be a separate scheme. However, we're a bit apprehensive about it because it just looks a bit like it could be viewed as tax avoidance, because the only purpose of the exercise is to avoid a lifetime allowance charge. So other providers might have a different view on that. You know, that's just our view, our house view. So, you know, we don't do it. We do know that the rules do say you can do it, but there's a little bit of a risk there that somebody might look at that one day and go, you know, why have you done this? Well, you know, it's artificial, the way things are going with sort of tax avoidance regulation, etc. So it's not something we were particularly comfortable with. But yeah, it is possible. And certainly there are circumstances where you may have somebody who might have, you know, a big DB scheme, for example, and they genuinely have a separate, you know, have a PP because you're from somewhere they work for a very short time period, a very long time ago or whatever, and they have a very small PP that you could use a small pension payment, and that would be fine. Well, that's sort of what it's designed for. Final one, trivial commutation lump sum, TCLS. So we used to be able to do these from DC schemes as well, but under pension freedoms, you don't need to do them anymore. You can just pay out, as I say, UFPLS payments or PCLS and flex access drawdown. So you can't have them from money purchase schemes anymore. It's only DB schemes that still do trivial commutation. And you have to have less than £30,000 across all pension schemes held for that individual. You have a one-off window in which you can commute all your pensions. So yeah, so you don't have to commute all your schemes. You do have to have less than 30,000 across all pension schemes. You don't have to commute all schemes. You can do some but not others. But if you don't do it in the 12-month window, then you've lost it forever. Any payment must extinguish all the rights under that scheme. There's no partials. It has to all be done. Taxed in the usual way. So if it's crystallised rights, then it's all subject to income tax. If it's uncrystallised, you can have 25% of it tax free. No BCE, again, so no benefit crystallisation on that, but you have to have a little bit of lifetime allowance available to be able to do it in the first place on that. So these are the rules that are in place currently. I say it was different before pension freedoms. And that is all from me today. So just to cover the key points then. So we have a normal minimum retirement age of 55 for now. I do expect that to be changing, even though it's not written in legislation yet, but we are expecting a change. Do be careful with one-off or UFPLS payments because of this taxation of flexible pension payments. the taxation issue, you need to obviously make sure that clients are aware that you know what's going to happen so you don't get any nasty surprises on that. Serious ill health option, I hope it doesn't happen too often to you and your clients, but you know, it's there for when you need it. Trivial commutation, DB only now, but you can still have small pension payments in the right circumstances under defined contributions. So that is all from me. Thank you very much for your time today. If you do have any questions, either put them on now or when you get the feedback in your CPD emailed to you, you know, please respond to that. Give you feedback if you have any questions. Myself or one of the team will be happy to answer them. But thank you very much and goodbye.